And we're now recording this session. I would like to turn things over to Meg Bodie, the president and founder of Talking Hedge Events. Meg, take it away.
Terrific. Thank you, Ken, and greetings to everyone. It's really good to be back. We took a break over the holidays, and as Ken said, this is now the opening webinar of our spring series. The spring series is replacing what would have been our sixth annual voyage to Austin. Austin still is very relevant, and it's where we started 6 years ago, and we've gone back annually, except of course for 2020 and 2021. But while we're on the topic of Austin, for all of our friends in Austin, and I think many of you are signed up today, we certainly hope that your recent traumas with your weather and lack of water and electricity and everything is getting better. And of course, with the COVID situation, that must have been terribly tough. You were certainly on our minds and in our hearts. And for all of the rest of you on with us today, we have 14 countries represented. So all around the world, all of you who are still dealing with, the stay-at-homes and the fear of COVID and safety issues, we certainly hope that you're healthy and that your family and loved ones are healthy and safe. So we have a terrific webinar for you today. Outstanding speakers. Looks like it's going to be a provocative discussion on due diligence, which we all know in the industry has been a bit of a difficult thing to deal with since nobody can get out and kick the tires these days. Before we get into our introductions, I do want to say, because we tend to be provocative, that all of our speakers are speaking with their own opinions and stories and not necessarily reflecting the views of the firms for which they work. So please bear that in mind. And I'd like to say that Talking Hedge has been really blessed. We have great, fantastic industry support. I want to thank the companies that have been supporting us over the years, in particular, InnoCap, Lixor, InfraHedge, which is a division of State Street, Bodie Research Group, Crable Capital, Efficient Capital, Graham Capital, O'Brien Investment Group, Rowe Asset Management, and Teza Capital. We are very grateful, and you will be hearing from all those firms as we move forward with the spring series, which right now has 8 webinars in the works. And again, this is the first one. I also want to thank our association partners, Kaya, CASA, and AMA, who've been very supportive, and that's all great stuff. So speaking of Kaya, we have Kaya Research here for you today. I'd like to ask Aaron Philbeck and Keith Black to pop on their cameras and pop on their audio. They are going to take over from here. So Aaron, as our moderator, welcome, and please take it away.
Oh, thanks so much, Meg, and thanks everyone for tuning in today. We've got a great discussion, and I'm really looking forward to hearing the different viewpoints. And you're right, I do think that there's going to be some provocative views on the topic of due diligence. Before I get into introductions, we do have a poll that we would like all of you to answer, so you should see that up on your screen. So take a moment, answer some of those questions. We're going to come back to those here after Keith gives his presentation and get into the panel discussion. Short, only 5 questions, 6 questions that you have to go through, and that'll kind of kick off the discussion. So without further ado, I'd love to introduce my colleague, Keith Black. Keith is going to be walking through a presentation on some of the results of a recent survey that Kaya Association did on due diligence, and specifically looking at the qualitative, the quantitative aspects, and the operational aspects, all encompassing that, of the due diligence process into the manager selection process. And what are some of those key considerations that both investors, LPs, and allocators focus on, but also the GPs and the managers and what they are focused on as well. So Keith, I'm going to turn it over to you and take it away.
So thanks, Aaron, and thanks, Meg. It's always great to be back with you, and have a lot of good friends on this panel today as well. So as Aaron said, this is joint research with Mark Rosinski. And Mark Rosinski came to us and wanted us to poll Kaya members regarding how they work with due diligence. And due diligence is a big part of the Kaya program. So we have a level 1 and a level 2 textbook and exam. Level 1 is bottom up, looking at each of the strategies individually, say hedge funds or private equity. And then level 2 is kind of the top down, the way allocators work. And so we have full 5 chapters in level 2 on due diligence. So we went out to Kaya members with a survey, and we said, only answer the survey if you're intimately involved with due diligence. So we got 233 investors and 111 managers who responded to this survey, and half of them are associated with firms over 10 billion in assets. So they're small investors, large investors, and we got the investor view and the manager view, and we wanted to see not only what investors and managers think about the due diligence process and how they work through the due diligence process, but see if they had the same views. Over 40% of our respondents have both the Kaya and the CFA designations, and all of them are intimately involved in the manager research process. So when we're looking at due diligence, it's the process of evaluating investment managers before they're placed in investor portfolios. And the first thing you want to do is see, does this manager have skill? Does the strategy have an edge? We want to look at it from a qualitative basis. We want to look at it from a quantitative basis. And then, of course, we want to look at the operational issues as well as the structural issues. And we want to put all of that together before we make an allocation to an investment manager. So just to set the terms, what we're going to talk about today is quantitative due diligence, qualitative due diligence, and then operational and structural due diligence. So quantitative due diligence is, what is their track record? How long have they been managing money? What's their return? What's their risk? Maybe what their asset growth is, and then benchmark relative performance. So how correlated are they to a specific investment strategy? And we note that emerging managers are going to have a hard time with quantitative due diligence because maybe they have a short track record. And so it's hard to get any statistical significance off of a track record of 0 months or 6 months. Then there's the qualitative due diligence. So this is the conversations you have with the investment team where you're evaluating the investment strategy and you're looking for their edge. What we're trying to figure out is, do they have the skill that could lead to persistent investment performance or outperformance? And then finally, we have operational and structural due diligence. So let's look at the internal systems, the internal controls, the risk management, the legal, the accounting, the prime brokerage relationships, everything that's not directly connected to that qualitative or quantitative process. So when we asked about the survey, we were asking about all types of investments. You see that the easiest strategies to assess are traditional fixed income and traditional equity. So because there's so much information available, because there's full transparency, because there's regulatory mandated board of directors and disclosure and NAVs and portfolio disclosure, those are relatively straightforward to perform due diligence on. And then we see venture capital, private equity, and managed futures as 3 of the strategies that are the most difficult to assess. And then real estate and hedge funds are somewhat in the middle. But what's interesting here is how we see the mix of quantitative, qualitative, and operational due diligence. We see that for managed futures and traditional strategies, that the quantitative analysis is most important, giving us over 60% of our signal. But for something like private equity and venture capital, especially if it's a new manager that has by definition no track record, you're going to rely almost exclusively on qualitative due diligence as your overview of evaluating that manager. So now, what are the quantitative factors? What are the qualitative factors? And then what are the operational factors? Just to put things in context, the quantitative factor that almost everyone looks at is what's your return? And in many cases, people will screen on returns. And so if you don't have that minimum level of return, you won't even get that first interview. But we certainly care about where that return comes from. So investors need to be able to attribute that return to specific alpha or beta factors. And clearly all of your returns are evaluated relative to other managers with a similar investment strategy. Moving along to qualitative factors, it's interesting that face-to-face meetings is the number one most important qualitative factor. And so we'll talk about what face-to-face means during times of COVID. But firm structure and organizational structure and culture are very important. So some of the consultants really prefer kind of the small boutique manager-owned firms relative to the large global asset managers. And obviously, there's a lot of references and referrals going on in the qualitative process. So what does culture mean? Ideally, what the investor would like to see from the manager is integrity. And I think this is one of the areas where the manager and the investor views really differed. That integrity, alignment of interest, and transparency are overwhelmingly important to the investor, and the managers didn't realize what was going to score as high on this area. And the very bottom is workplace and office layout. So again, is that going to change with Zoom? What we're trying to do in the investment due diligence, when we're qualitatively talking to the manager about the investment strategy, what we'd like to decide on is what's the manager's skill, and do they have the ability to continue to earn an above market return in a persistent way. So we're looking for that edge, and that edge comes from experience and research and the ability to work with market inefficiencies, and scale again is not an issue. So again, we're going to see that asset size doesn't necessarily matter, and that emerging and boutique managers in many cases are actually preferred by investors. So when we move along to the operational factors, it's really about valuation policy and compliance. If there's something wrong in the compliance culture of the firm, if you don't trust or don't understand the valuation policy, it's going to be difficult for investors to approve an allocation to your firm. And then again, for emerging managers, size doesn't matter. So if you could somehow pass the operational screen and the investment screen, investors are going to have an open mind about emerging managers, but they're going to hold the emerging managers to a pretty strict due diligence process. And they're really going to evaluate the quality of the operations, the investment infrastructure, and the research. And so it's going to be hard to get an allocation as an emerging manager if you haven't made those investments in the quality of operations or the investment infrastructure. And we'll talk to our due diligence experts and see if whether that needs to be in-house or outsourced. So at the end of the day, what Kaya members believe is that it's the qualitative factors that are most predictive of a future performance. So if we're looking to hire managers that are going to outperform in the future, quantitative factors are not sufficient. So you can't simply take an investment track record, look at the risk and return, and evaluate from that which managers are likely to perform in the future. You need to get at their culture, need to get at their integrity, and try to determine their skill and their edge through these qualitative conversations. So that's the overview of the survey that Chi Association has done, and so it's great to be in on this conversation and see how our esteemed due diligence experts react to the survey.
Great. Well, thanks so much, Keith. And I think that's your cue, Ron, John, and Esther, if you want to turn on your video and your microphones. Before we pull up the results of the survey at the beginning of the presentation, Esther, maybe you go first, and Ranjan, just give a little bit of background, introduce yourself for those in the audience who may not know who you are or what you do, just before we get started.
Sure. Thanks, Aaron, and thanks also to Meg for organizing this event today. I'm Esther Zerba. I'm a director with Castle Hall Diligence. We're a dedicated due diligence consultancy, and we've been in operations around 15 years. We serve a global clientele, and we provide diligence solutions, which we call fintech-enabled risk management solutions. We don't run portfolios. We don't do any investment advisory, and we don't provide manager pays due diligence. So we have a model that's unconflicted. It's, we're providing, we always like, if you're on the allocator side, you want to see a clear segregation of duties between front office and back office. We're providing that, if you will, from, the segregation of duties between the governance, risk, compliance, due diligence workflow and that of advocacy of an investment advisor or consultant. I've been in the industry for nearly 20 years now. I started when I was 5. And I started out actually on the other side of the diligence desk. I started out working at a hedge fund. I've been doing dedicated operational due diligence now, 5 years of which at a bank, and the last almost a decade now at Castle Hall, dedicated operational due diligence. And we cover, it's cross asset class. We cover everything from hedge to closed-ended structures, long only, and all stages of the life cycle of the asset manager, from pre-launch, brand new venture capital funds to managers that are multi-mega billions, very large and established institutional grade operations.
Great. Ranjan?
Thank you. Thank you very much, Aaron and Keith, and also thanks to Meg Bodie, and most of all, thank you to the audience for listening in. My name is Ranjan Biduri. I'm CEO of Bodie Research Group and also the founder of Bodie Research Group. We're based in Toronto, global in reach, and we work very closely with family offices, pensions, institutional investors in alternative investments with regards to different portfolio matters, manager research, due diligence, portfolio construction, and special projects. And with regards to myself, it was 20 years ago that I started in due diligence. I started on the investment due diligence side, doing manager research. I became bilingual in getting fluent in operational due diligence. I've always applied a lot of statistical analysis, and because I have a PhD in mathematics, so a mathematics background before entering into finance. And then structural due diligence is something also where I've done a lot of that as well. So looking forward to today's discussion.
So Ranjan, is the bilingual qualitative and quantitative, or English and French?
I am ashamed to say that I am still not fluent in French, even though I did get good grades in high school, but my excuse is that I was in Ontario, although I did grade 7 in Montreal, which is considered high school there, but when they heard us from Ontario, they put me in a remedial French class. So it's one day I will get fluent in French. So
the bilingual is qualitative and quantitative.
Exactly. Yeah.
Well, great. Could we bring up the survey results from earlier in the session? So if we just want to, I'd love to ask the panelists here, but maybe I'll start with Keith. So we've got primarily investors here in the group. Most of them are involved in the due diligence process. Investment due diligence over ODD. So Esther, I don't know how you feel about that, but we can get into that. And then, maybe not surprisingly, number 4, relying both on quant and qual equally. And then in-person versus virtually, which I know we're going to talk about here in a second. But Keith, just given, the survey that we've done versus kind of this snapshot that we see here. Any surprises or any comments you'd like to make?
It looks like the audience for this call is exactly the same audience we had for our survey, right? So more investors than managers. The majority are involved in the due diligence process. But what's interesting is question 4, that they get the joke that both qualitative and quantitative due diligence are equally important, which was the key hypothesis we had before we did the survey, right? I think Ranjan, the hypothesis for the survey was that qualitative due diligence is undervalued or underloved, right? That maybe a lot of people understand the math and wanted to focus on quantitative things. And so what we were trying to bring out in the survey is that qualitative due diligence is as important or more important than quantitative due diligence. So do you need to be bilingual to do due diligence, or what are the limits, Ranjan, of quantitative analysis?
Yeah, no, it's a great question and great to sort of delve into this. And just to remind the audience again, the way that Kaya has defined qualitative and quantitative due diligence in this study is as a subset on the investment due diligence side. But I mean, when I first started, I was very, very fortunate to learn under George Main and Warren Wright. They were the CIO and portfolio manager of a $4.5 billion market neutral fund of funds. And then there was $10 billion in synthetic indexing. And it was, neither of them, both of them very brilliant, very excellent, but neither of them are quants. And one of the first things they told me was that the qualitative is more important than the quantitative. And it gave me a really, a really good opportunity to learn a lot about the qualitative due diligence and how important it is. But what I think that one thing in our industry that should be avoided is that it shouldn't be thought as that the quantitative due diligence is, if the quantitative is more important than the quantitative, or it shouldn't be that quantitative due diligence isn't important. In fact, like my own assessment, and this is where I'll start the controversies, is that, I think that the industry by and large is somewhat, that there's a lot of improvement for the quantitative due diligence. And so there's a lot of insights that one can get in if one does quantitative due diligence intelligently and rigorously. And part of that is also marrying the quantitative due diligence with the qualitative due diligence as well. That in some ways, that's a very, very vital step.
Could you give some examples when you talk about, the improvement that you've seen in quantitative due diligence? What do you mean by that? Elaborate.
Well, I mean, I think that there's, for those who haven't read Ed Thorp's book, Ed Thorp was a mathematician who first came to prominence in writing a book, How to Beat the Dealer, and he solved blackjack. And then he was a pioneer in the hedge fund industry. He may have co-founded the first stat-arb hedge fund trading strategy. But Ed Thorp was, in his biography, or autobiography, he wrote about how a client came to him. He was doing consulting, and this client was showing him Madoff's returns and saying, I want to invest in this. What do you think? And Ed tried to get, some access or transparency from Madoff, didn't get it, because that was the way Madoff did things. But so then Ed just did the quantitative due diligence and did a lot of statistical analysis, understood, he understands the markets, and he warned his client, stay away, stay far away. This is just not feasible, and this is fraudulent. So, and so he saved his client a whole lot of money. And that was purely from quantitative due diligence.
Now, Ranjan, that's really interesting because some people would say that Madoff would score very high on quantitative due diligence, right? Because he's got high returns and low risk, right? So I was involved in litigation, not for anything I did. They were trying to help. I was helping them explain the situation where someone built a fund of funds, right? And they ran a quantitative screen and they said, I want to have managers with minimal drawdowns, right? With low downside risk. And so they ran the screen and they built a fund of funds with 7 managers. And when they put the 7 managers together over the history, there was no drawdown for the 7 managers as a whole. And so they felt confident that because there was no drawdowns, that they could lever up this strategy using 7% cash leverage. And of course, it was levered probably 5 to 1. And so it turns out that more than 100% of client capital was invested in Madoff, and more than 100% of client capital was invested in Petters additionally.
Oh,
right?
yikes.
So this is where you need someone to come in and explain due diligence and risk management to the lawyers after the fact.
Yeah.
But so quantitative due diligence, Ranjan, if you look at just the risk or just the return, you're kind of missing something. So the punchline to Ed Thorpe's story is that you, in addition to looking at risk and return on a standalone basis, you also need to quantitatively compare that strategy to competing strategies for realism to the market, that if someone has such a large tracking error relative to others in similar strategies or what the market opportunity is, that could be a signal for fraud right there. So it's not just how good is your return or how good is your risk, but how feasible is that strategy compared to the market environment.
Absolutely, Keith. I mean, that's a very important illustration that you just gave, and it's critical to understand what the trading strategy is, and in marrying the quantitative with the qualitative, looking at the track record, sort of seeing, okay, where were the best returns, where were the biggest drawdowns, why did that happen, does that make sense? But it's also like there's also some folks who are not using the quantitative tools correctly, right? Like they'll say, okay, there's hedge fund A and hedge fund B, each have 5 years of statistics or 5 years track record, and now they go crazy on the stats. But meanwhile, hedge fund A is illiquid, and you can, only, it's a 2-year lockup. You can only redeem once a year after that 2-year lockup, and the other one is very liquid, and there is no lockup, and there's monthly redemptions. And if you just compare the statistics, you're giving liquidity a value of 0, right? And so these are, there's just so many examples of this. And I would also state that quantitative due diligence today is even more important than 20 years ago because of the fact that there's a lot more alternative beta products out there. So you can do the proper statistical filter and statistical filtering and analysis to make sure that, you're not paying alpha fees for an alternative beta product. And, all of this also should be coming downstream from intelligent, prudent portfolio construction. So where if you're not applying the right quantitative techniques there, it's just error after error, just compounding in some sense.
And I'd also like to throw in there, Ranjan, Keith, you made some excellent points. Keith, I was really excited to see that it's borne out in the research that, that integrity is really high, and that's evidenced by alignment of interest and transparency. So, to your point, Ranjan, where there's, the statistical analysis, the quantitative analysis may look good, but when you compare that to, for example, if a manager doesn't have an appropriate level of skin in the game in the exact fund vehicle that external investors are invested in, then there's potential for issues there. If a manager has their own personal capital in segregated employee-only vehicles, they might be cherry-picking trades, they might be cherry-picking strategies, they might be levering it, they might be doing something completely different. To your point, where there's no transparency up front, that's or little transparency even at a pre-investment stage, that's already potentially an indication. If that's how an asset manager is during the honeymoon, what are they going to be like when I'm invested? And what if that fund happens to have what if you're locked in for a longer period? These are issues that you raise. And I have to say, a pre-credit crisis, there were a lot of these types of Petter style funds that had really amazing looking return streams that were just implausible, and there had to be something wrong. And sure enough, the things come out of the woodwork when the tide is down. So,
but Esther, if you download that track record and you put it into your existing portfolio at a 5% weight, it really helps the risk and helps the return of your portfolio, right? So if we take kind of quantitative analysis to the extreme, these managers look really good in hindsight. So you can't just blindly use that quantitative analysis on its own. Because exactly. I think what happened with Madoff was that people fell in love with the track record, right? That the returns and the risk were so strong, they kind of plug this into their allocation model, or unfortunately make it their allocation model, that you kind of shortcut the operational and investment due diligence when that track record is so strong.
Yeah, I mean, and Madoff wasn't, he didn't have any vehicle per se. So, there were all kinds of other issues related to that, and there was high degree of lack of transparency, obviously, but many investors, I think, relied on word of mouth, and other investors, oh well, so and so is invested, so it must be okay, rather than doing their own due diligence.
And look how much money they made on it.
Esther, I want to stick with you because I think one of the most interesting replies to just the SNAP survey is the IDD versus ODD. Maybe this is your chance for a rebuttal, but prioritizing IDD at 65% versus ODD. What are your thoughts on that? Does that concern you, or does that surprise you at all?
Well, I mean, I think the IDD, the IDD is the one where without IDD, there would be no reason for ODD.
Sure.
I mean, IDD is the starting point. The front office investment professionals are looking for return solutions, and identify the managers with the strategy, the investment strategy that they want, with the with the type of track record they're looking for, et cetera. And then typically ODD, to the extent that it is being performed, comes in at the fairly close to the investment decision, and that's at the point where a lot of in some cases the investment front office professionals consider the ODD process as an annoying stage in gatekeeping to putting on a deal. And I think the ODD process is also really about understanding who you're doing business with, but laying out a plan for excellence. And operational excellence to that point can contribute to better returns. And I think
Esther, I was a consultant for a while. I met over 400 managers, and I had the luxury of not having to hire every manager that came through, right? We had a pretty steep funnel that maybe of the 400 managers, there's only room for 20 or 30 in our portfolio. But I could eliminate half of my managers in a 1-hour meeting, right? So I could do IDD, ODD, quant, and everything all in 1 hour, right? And so I was basically asking them 3 questions, and they weren't this obvious, but this is what I was trying to get at, right? What makes you smart? What makes you different? And what makes you careful, right? And in 1 hour, you can determine whether they have credible answers to that. And so in the first hour, you could tell if somebody's going to fail ODD, right? And in the first hour, you could tell that somebody has kind of a generic, undifferentiated investment strategy. And so you don't have to do, hundreds of hours of investment due diligence and then do ODD at the end. You could have a kind of a simple screen at the beginning that in 1 hour, you could actually eliminate a lot of managers from not being smart or not being different or not being careful.
That's a great point that you bring. And, even taking that further, an experienced eye, I can take a look at a tear sheet and I can tell you immediately if it looks like it's going to be a fail. and I've done a 5-minute scan of an offering document and thought, oh no, this is not going to look good.
For 8% fees and 5 times leverage using cash borrowing.
Yeah, exactly. So
Now,
Keith, what you just stated, Keith, is a very good point, and it goes to the communication between investment due diligence and operational due diligence. When I was at Morgan Stanley, and this is pre-Madoff, pre the financial crisis, we had I was doing investment due diligence, and I was also part of the portfolio construction team where we designed customized portfolios of alternatives. And there was a pretty big investment due diligence team. There was only one person doing ops DD, poor guy, Jason Sharpman. And he was always traveling all over the place and constantly behind naturally because he was one person. And I was I was always very, calling him up and sort of saying, okay, I'm going to see this manager. Is there anything on the ops side you want me to check in on? And I would, sort of learn from him what his standards are, because that would, gain theoretically, because he has veto power, you don't want to even go near a manager that is not going to, have the proper operational standards and infrastructure. So it's important, from that communication perspective. It isn't surprising on the survey results from today's audience about IDD, that 2/3 are saying it's more important, but I would dispute that IDD is more important than ODD. At the end of the day, there's, it winds up just being binary. Either the investor invests in the manager or the investor does not. And the hardest thing, it's proven time and time again, in the academic literature as well as in industry, but the hardest thing to predict is returns. Okay, volatility is a lot easier to predict, even correlations. I recommend reading Günter Meissner's book on correlation. Correlation can be unstable, but return is totally, very, very hard to predict. And when you talk about managers, there will be in that investment strategy a Goldilocks environment where that manager should be able to make a lot of money, then the steady state, and then a certain environment where it's going to be more challenged and somewhat vulnerable. But if they don't have a culture of compliance, a strong, strong legal team in terms of, that could be external counsel, but just if they don't have a strong operational infrastructure, the probability of them staying in, being in a position to profit when that Goldilocks environment happens is not going to happen at all. Like, they'll be out of business before then. So the ops DD, I think way too many investors make the mistake, and this is a really bad mistake, that they view operational due diligence as a cost center. operational due diligence more than pays for itself. And especially now with, the structural due diligence being part of operational due diligence and being able to ascertain, okay, how should we, how should we invest in this hedge fund strategy? Should we do a fund of one? Should we do a managed account platform? Should we go into the commingled fund and so forth? So there's a lot of nuances in all of this.
And Ranjan, what's interesting is Jason Sharfman has written a number of books, one specifically on private equity operational due diligence, and then a second on hedge fund operational due diligence. And he's a key contributor to the Kaya Level 2 coverage on operational due diligence.
He's actually, he's a great guy. I haven't talked to him recently, but I'm on the back cover of his operational due diligence book on hedge funds because he asked me to read the transcript before it got published. And I wasn't surprised that he asked me because, as I said, I was the only investment due diligence analyst who really, appreciated, I think, all that he was doing. Not to say that others didn't, but I was pretty proactive in a lot of my collaboration with him.
So, and speaking of operational due diligence on private equity, I think what surprises me is the extent to which there is a lack of operational due diligence on privates in general, not just private equity. I think if you consider 15 years ago, operational, like post Madoff, people really started doing operational due diligence to some extent or another. But still to this day, there are many allocators that are not doing operational due diligence on their privates, which they have their front office professionals doing some kind of ODD light. And if you consider, back in the days when I worked at a hedge fund, if 2% of people were coming in to do anything that was dedicated ODD, that was probably generous. And at the analysts who were coming in might be saying, oh, do you have a fund administrator? Great, check the box. And to me, that may or may not be the case for privates in some cases, but it's certainly not while operational due diligence is very much a mature exercise, there are still a number of allocators who are not used to conducting the exercise themselves, or there are still GPs out there who have never gone the type of extensive operational, dedicated operational due diligence exercise that that a dedicated team would conduct. So it's certainly interesting from that perspective.
Now, Esther, why do you think that is? Is that just a manage what you can measure type of thing, or what? I guess when you look at public versus private, why might that be the case? What's your view on that?
Well, it's interesting because they, in many cases, when back in the day, the response was, the response is, well, there's less risk, and there's you're locked in, and there's no evaluation risk because everybody's locked in. There's no you don't have to worry about existence, etc. But actually, all of those risks they still exist, but the questions are different, and how these issues are addressed is different. And so that's where I still think there are some institutions that deem it to be of lesser risk.
Yeah.
So Esther, what is the meaning of operational due diligence or on-site face-to-face meetings in a world of Zoom? Does Zoom make it harder or easier to get access to what you need for that on-site or face-to-face?
So I'm agnostic. it's, if you consider the back when we were doing on-sites pre-COVID all the time, if you were to go to a manager's office and if half of their team was videoing in and you're in the boardroom and they're showing you something on screen that they control on the cursor, I'm not really sure that that has much substantial difference to what we're conducting today. So, if you consider the operational due diligence exercise as, what types of business risks are there at the management company, what can go wrong at the management company level, which includes compliance and regulatory issues. And at the fund level, what are the structural legal risks? What could possibly go wrong there? And in the control environment, do I have, existence, cash controls, valuation, calculation of the NAV? I think that there's certainly a place for in-person meetings. And I think it's up to every single institution that allocates to determine how important it is to them to have a personal face-to-face meeting and to actually, look someone in the eyes personally. From the ODD perspective, I don't think that there's, I'm able to conduct operational due diligence reviews to the same professional degree right now as I would have been also while going on site. So in terms of transparency, if a manager was willing to show something on site, they're willing to show it in some kind of virtual sharing environment. So there, from that perspective, I think the question going forward is, what does tomorrow look like? We don't know what public health guidelines will be going forward. Do portfolio managers really want to have a string of investors coming into their offices that they don't know they don't know if everyone's been vaccinated? Like when will international travel restrictions be limited? There's a lot of questions looking forward.
Now, Esther, there's actually a question in the Q&A that ties into this on virtual ODD or Zoom diligence, if you will. I guess the question here is, have there been any circumstances where you've actually gained more access virtually than you would have in person?
No, I'd say it's probably the same. Again, it depends on the manager's level of transparency. If they were going to share something on site, then they're open to sharing it in a virtual environment. In some cases, at the beginning of COVID, there was so much uncertainty that managers were less willing to share things in a virtual sharing environment. But I think that changed fairly quickly as the months started dragging on, and I think everyone is now used to this. I think another question, even more, to that point, is who's going to underwrite now the travel expenses for conducting investment or operational due diligence on site? Who wants to underwrite that expense when we've been going on for a year now, conducting these all due diligence in a virtual environment. I think it'll be up to every institution, every allocator to determine, to what extent they're open to underwriting travel expenses going forward. How, maybe for a very material position, or if the relationship is material, or if there's some specific issue that needs to be addressed.
Yeah. Keith, I want to talk a little bit about Edge, because I know one of your first questions that you ask is what makes you smart. And that was, one of the big things in the survey as well. But how has that Edge, or what generates Edge, changed over the past, let's say, 20 years? I mean, you have new technologies, you're using AI. There's a lot of different things that are new as part of the process. So how has that changed?
Yeah, so I think the first thing is it's important to work with someone, like Esther or Ranjan on your due diligence team, right? And so because if you've worked at a hedge fund, if you've worked in manager due diligence, you really get it, right? And when Esther said the word checkbox, right, my skin just starts to crawl, right? Because due diligence shouldn't be a checkbox. And so the number one way to get thrown out of our office is we had Keith, Sam, and Matt, and you guys might know Sam and Matt. We had Keith, Sam, and Matt, and I think that most Kaya members can do a perfectly average job of managing money, right? And you've got the playbook, you kind of understand how things work, and you're going to be careful, and you're going to have the ops okay, but you don't have that edge that's something extra. So the number one way to get thrown out of our office is if Keith, Sam, and Matt could replicate your strategy, right? And there's nothing secret, there's nothing special that you do. Then we have no business, hiring you. And don't come to Chicago and say you know how to manage options when you don't, right? Because there's a lot of smart people in Chicago who know that you don't know what you're talking about when you're running options. But what we've seen recently, Aaron, is that that hedge funds that deploy AI and machine learning are actually outperforming those that aren't, right? And so kind of a new question to ask is, how are you taking advantage of alternative data, right? So do you have, credit card data and drones and satellites, and, are you buying data from Gmail to sort through people's email stream? And there's a lot of edge in that, but you want to make sure they're not overfitting at the same time. And so I think looking to what extent the manager is taking advantage of those, because that's an area of edge, right? And if you're able to engage in that quantitative pursuit, well, that's another way that makes you smart and different.
Rajan, any thoughts on that?
Well, it's your original question. I mean, first I concur with Keith, but your original question also says about Edge over 20 years. I mean, so much has changed in 20 years. Well, I remember, like, now I go beyond 20 years, but when I was a child, like, I was taught, don't talk to strangers, don't go in a stranger's car. And now, of course, Uber became a multi-billion-dollar enterprise by, just entering strangers' cars. So you have to be able to adapt, and everything. It's exactly what Keith stated about, it's due diligence is not just some kind of questionnaire. It's always going to be path dependent. Every hedge fund manager is unique in itself because there is a human element, even if it's a purely systematic trading program. There's so much that goes into designing these algorithms and so forth. And with machine learning, one has to be very careful that, it's almost like there's three different, like a few different categories. There are those that are just stating things with machine learning that they're doing it when they're not really doing anything. That's, but like tech, and it all, I mean, one can say regression is a part of machine learning. So maybe they're doing a little bit, but they're not really doing anything. And so, they'll bring it out for marketing purposes. And then there's another group that is doing it in earnest, but they don't necessarily have, they're not necessarily thinking through all the risks. And there could be some kind of catastrophic risk if they don't have somebody senior or really, who understands the finance and the markets as well. And then there's a third group that are doing, that are doing it and doing it well, that understand the markets and understand the math. So one has to be, really, really careful in all of that.
Maybe with our last 5 minutes of the session, I can ask each of you to kind of look into your crystal ball, post-COVID, but even beyond post-COVID, longer term. What do you think are some of the major themes that will emerge in the world of IDD, ODD, you name it, just in due diligence. Where is this whole part of the process heading? And maybe I can start with Esther, Ranjan, and then end with Keith.
Thanks, Aaron. I think that, looking forward, I'd have to say that, while we have, for years, so the Ranjan, Keith, between the three of us, we've got a lot of years of due diligence experience under our belt. So we have the ability to have that, to add in that art into the science. And, but I think that the days of, the days of just telling a manager, well, I think you're off market because based on my experience, I think that no longer cuts it. And it's important to have, to move a conversation forward, it's important to have evidence to your argument. So that's why I was excited to see that, valuation policy is important. And, from, because, where we collect data, for example, I can say to a manager, well, if, you don't have a valuation policy, but, you're one of 3% of managers that don't have one, you're really off market. I think that really starts driving the conversation forward. Or, you're now less than 10% of managers who are willing to share correspondence. So that really from regulatory inspection. So I think that those types of an evidence-based approach really drives conversations forward. And I think that just looking forward, in this industry, everyone is looking for constructive feedback and how to do better, how to be better, because everyone recognizes that that having a running a good business and running a solid operations can will contribute to a longer sustained business model and support their strategy.
Ranjan?
Well, I'm gonna maybe change your question very slightly and just start by saying what hasn't changed in 20 years, and then try to say, instead of where is it heading, where are the smartest people heading, right? And so what hasn't changed is in the end of the day with due diligence, you're always looking just for four things. First is integrity. If you don't trust the manager, you're not going to trust them with your money, and you have a fiduciary duty. So the integrity has to be there. Then you're really looking for the ability to make money, the ability to not lose money, i.e. risk management, and the ability to manage the business. And each of these are extremely deep, and it's path dependent, as you know, and it takes a lot of work. There's no substitute for hard work. I do think that going forward, and it's even happening now, is that the smartest groups are going to be using having customization and using managed account platforms. That from an investment perspective, it allows you much more opportunities on the ESG side. It allows you to truly customize the investment congruent to what you need in the overall portfolio construction. And if you don't use a managed account, then you're just a taker. It's one size fits all. So and the other piece that I'll state is that multi-billion-dollar manager is fantastic, right? Most groups should have some of those in their portfolio for sure. But the smartest groups are also going to be allocating to emerging managers and seeding managers. And on the investment due diligence side, if you're out there doing investment due diligence, I challenge you by asking, how hard is it to state that Roger Federer or Serena Williams is a great tennis player? It's pretty easy, right? So if you only invest in multi-billion-dollar managers, how much value are you adding, right? To your portfolio, who's going to be the next tennis player to win a Grand Slam, right? So yeah, I think that these are some of the areas where the smartest groups are going to be invoking more customization.
Great. Keith,
So
take us home.
I know people hate words like quantamental, or if we want to come up with a new word like quanta IDD. I think what we might see in the future is kind of based on what Esther said. There's 2% of managers who don't do this and 10% of managers who don't do that. So I think what we'll see in the future is somewhat of an automation or a quantification of the investment due diligence and of the operational due diligence. And so there's probably going to be databases coming out that pull in everybody's DDQs, and there's going to be kind of searchable DDQs, and you're not going to get that first interview, if you can answer, what makes you smart, what makes you different, what makes you careful. So if there's red flags in your DDQ, we could kind of quantitatively search on DDQs across managers, and if you're not going to meet that standard, you're not even going to get to the face-to-face. And so there's going to be a way to kind of fail, just like we've screened on managers. If you don't have whatever an 8% return, you're not going to get the call. I think we're going to see the same thing on the IDD and the ODD. That if you are off market on your terms, you're not even going to make it to that first meeting.
Great. Well, with that, we are slightly over time. I want to thank our audience for tuning in, and thank you to our panelists for such a great discussion. Meg, should I turn it back over to you or Ken? Or
Thank you.
I'll be happy to come
I'll
back
just
on.
pop in. Oh, Ken, okay, go ahead.
We're both here.
Thank you, everyone, for tuning in. It was a great discussion. What a way to open our series. I was so delighted to be able to share research and so much great opinion, and the stories were great. You guys really knocked it out of the park. And interesting way to wrap. I mean, the forward-looking comments were fantastic. So thank you all so much, and thank you to our audience. Have a great weekend, and we'll see you again next Friday with a discussion on the fixed income conundrum.
You want to come back next Friday? I think Elizabeth Burton, the CIO of
Elizabeth Burton, Marcus Frampton, yes, Crable and Rowe. It's going to be a good one. So hopefully we'll see you next Friday.
thanks.
Thanks,
Thank you.
everyone.
Thanks, everyone.